Hey everyone, welcome to the KE Report and another daily editorial. This time chatting with Brian Leni, founder and editor of the Junior Stock Review. I'll post a link in the show notes to Brian's website. Now, Brian, we got to spend some time with you in Vancouver over about the last week or so at the conferences, Metals Investor Forum and the Vancouver Resource Investment Conference. You spoke at the Metals Investment Forum, and more so I want to get kind of a recap from you in terms of your conference takeaways. Look, I feel like at the beginning of the year, there is always this excitement for the new year from investors. A lot of people on the floor really looking forward to hopefully what will be a good year for these underlying stocks, even the stocks that struggled last year. A lot of people still at least trying to be optimistic for this year, especially on the capital raising front. What were your takeaways from the conferences that we just saw you at in Vancouver, Brian?
Well, thanks for having me, guys. I guess first and foremost, the takeaway, as you said, the vibe was great at both conferences, probably especially Metals Investors Forum. I think there was a really good, positive sentiment that was going around with both the investors and the issuers that I spoke to. And I think I always contrast that versus, the last conference or the last couple conferences I went to. And it was definitely better. There was much more optimism for this year. Maybe that's the gold price. I'm not really sure, because in terms of the equities, we certainly didn't end the best in the resource sector in 2024. But for me personally, I'm definitely positive. I was able to meet with a number of companies, both in the portfolio and new ones. And overall, I was super happy with what's going on within especially the portfolio companies. There's a couple companies in particular that I think are really going to stand out in 2025. And the portfolio is positioned well. Those two companies are Kenorland and Aurion Resources. In terms of the other sort of takeaways, I think that it was really good to see the amount of investors that I was able to speak to this time that had questions, not only about precious metals, but base metals. I think considering the year last year that was definitely precious metals focused, a lot of the investors that I was speaking to had a lot of questions about base metals, and I didn't really expect that. And so I think that's a positive, especially when you look at the amount of uncertainties that surround Trump's inauguration, what he's going to do with the tariffs, and how that precipitates into the base metal market, which I think is probably the most prone to being impacted, both positive or negative, with whatever comes of it. So to me, that was another really good takeaway, and something that I think to be positive about for the rest of this year.
Well, Brian, I also thought you had a great presentation at the Metals Investor Forum to the audience, and you were covering a lot of ground in it. You covered some companies, but you also covered 3 reflections back on 2024 that you just learned in your own investing career and how that would apply moving forward. Maybe share just a quick snapshot of that for folks here that missed that talk.
Okay, and thanks for that. Yeah, so every year I look back on my previous year, both the positive and negative, and see how I can apply that to the coming year, play to my strengths, but also try to stop certain mistakes that I may have made. I think the first point that I covered was mistakes in general. And I think the realization that I had to come to is that I can't beat myself up too much about the mistakes I make in the sector, even though a couple of them I've probably made to different degrees, the same one multiple times. And, I've had some tremendous mentors in this business, and, most of them have been mentors from afar. And what I gave was an example of how I use my mentors. And there's a book called Think and Grow Rich by Napoleon Hill. And there's a chapter in there where he talks about having a round table in your head and sitting each of your mentors around that round table. And when you have a decision to make, you bring that decision to your round table and you go through it with each of your mentors' sort of points of view. And if you've listened to people long enough, I think anyways, or I'm able to sort of take their side of a story or a decision to make, and see how everyone goes about it, and then I make a decision. And to some that might seem hokey, but I can tell you that it's really helped me, and it's something that I think if you started to incorporate yourself with not only just investment decisions but just general life, I think if you can start to visualize those sorts of things, it can really help you. And again, those mentors that are seated at your that table in your head, you don't have to know these people. You listen to enough people in interviews, podcasts, whatever, read their books. I think you get a fairly good understanding, if you've listened carefully enough, of what these people are all about. And so to me, to have them, in your head and being able to bounce things off of them is a huge advantage. Next was allocation, and a big, 2024 was a great year for the junior stock premium portfolio. The average weighted return was over 150%, which, the more people I talk to, it seems like that definitely stands out as one of the better returns. A couple companies in general that made the portfolio stand out: G Mining and Montage Gold. Montage Gold was around a 300% return, and G Mining is around 250%. And when these things are weighted to a higher degree, of course, those wins are compounded even more. And that allocation percentage is really what honed in on the fact that these high conviction picks that I have, I need to be going to around a 10% weighting for a couple of reasons. So that the impact when I'm right is powerful. Secondly, if I'm wrong, and I'm going to be wrong, it's just to what degree, that it's not going to kill me. It's not going to, remove me from being an investor within the resource sector. And so I don't think it's ubiquitous that 10% is what everybody should use. It's definitely not. But I think every investor should be putting some thought into what sort of allocation they're going to put for each of their picks, especially if they're going to put all this time into researching a company and, following a company. When you're right, you really want to be right. Second to that, I think for like the newbies, what I would say is that you want to go with as few companies as possible. Have a huge cash position, but have a few companies that you know extremely well. And this will allow you to I think, learn the most. And again, not put yourself in a position where you can lose it all and then get kicked out of this business. Wealth is built over time, over a lifetime, I would say, not a week, month, year. And so when you keep that sort of perspective, I think it allows you to play with these allocations and sort of, especially if you're new, to take your time. And then the final point was on timeline. Timelines are so important to our investment thesis. We come up with, we do all the analysis on the company, come with a valuation, then we say, okay, they've got all of this stuff planned for 2025, and this is what's going to be done in 2026, looking out even further. And this is how I think the value is going to be added and where the share price should go correspondingly. The problem is you really have to know where you are in the cycle. In a bear portion of the cycle, like let's rewind 2 years back, in the bear portion of the cycle, timelines completely slow down or are completely non-existent, meaning that good news is sold or just nobody cares. And so the company keeps on getting better and better, and yet the share price stays where it is or floats down. And this is obviously the times when you want to buy. Conversely, when you're in a bull portion of the cycle, probably what we're coming up to, the market begins giving companies credit for stuff that they're going to do and yet to be successful for. And this is where, obviously is the dichotomy to the bear market. This is, and the time to buy, this is probably the times when you have to be looking to sell. And there's more that comes into it, but staying at a high level. Obviously the bear market is when you buy and the bull market is when you sell, especially when when credit's given to a company before they actually even achieve something. And so you have to be on it when it comes to forming a valuation. So these three things are what I contemplated over the last year, and I will be, or have already started to implement into my 2025 plan. And of course, those that are readers of the Junior Stock Review Premium newsletter get access to that, and you can see what the plan is from my weekly newsletter.
So Brian, look, a sector of stocks within the metals sector that you really focus on are these development plays, right? And those ones, a number of them did do very well last year, as you said, G Mining being a real standout there. And it seems like that has almost been a sweet spot for this sector. The micro caps really haven't gotten moving unless they have just an amazing discovery, which there have been a couple of. And the big major miners, they're doing pretty well too, but they haven't really offered any sort of leverage to the underlying metals price. I know that that's your specialty, diving into all these economic reports and building your own. But even though you focus on it, is that, do you think, still the sweet spot for this sector in 2025? Not the juniors, not the majors, but this mid-tier group that if they have money, they can fund a build, or they're early on in production, that they could continue to outperform the market?
It's a good question. I guess I don't really have a direct answer for that, because what I would say is I don't really think or look at the market from that perspective. My focus on the developers has always been because that's where my strength is. And I know that I can go, if as long as the company has a resource or something that's real, I can put some numbers to it and come with a valuation. And so that's why I've personally stuck there. And I think the timing, usually in these bull markets, it starts at the top and trickles down. And I think that's sort of what we've seen. It's what you outlined. And so in my Metals Investors Forum presentation, I do think exploration is where the biggest value, if you want to call it that. It's still pretty ambiguous, like of what that value actually means. But you can buy a lot of these exploration companies fairly cheap. Now, I would put the caveat as this. My strength is developers. Obviously, I'm an engineer, and it definitely fits with my sort of mindset. I do know some geology, and I have some friends that I can talk to about different projects. But for me, I play exploration through the prospect generation business model, or hybrids of the sorts. And I still think that there's some tremendous deals out there. As I said, Kenorland and Aurion Resources, Kenorland is a straight up project generation company. And I would say Aurion is kind of the hybrid of the sorts. I think there's a lot of value there. And especially when you look at a company like KLD, their portfolio, they're going to see, let's say, $20-ish million spend, plus they're going to spend, let's say, 5, 6, 7 million on the portfolio themselves and developing those so they can option those lesser projects into, top tier candidates for senior mining companies. There's so much value to be attained there. And I would say, especially in those two instances, they actually have some retained value, even though that they're exploration focused. In Orion's case, I think there's going to be a deal on Helmi. B2 and Rupert have already come to $100 million deal on 70%, but that 30% is still out there. And if you look at the optimization for that Ikari pit, I just think there's a deal there. And to me, it's a low risk way to play exploration, considering too all the potential at Risty. That golden till anomaly that they just put out last week, 900 gold grains in their HMC sampling. And that, if you look at what the trend that's on, that's right in trend with Karis and all of that 800 meters of strike that they've outlined. And it of course, the golden till anomalies towards the Helmi project. So, there's so much there that can happen, and it's backstopped by that Helmi underlying value. In Kenorland, the underlying value is with Renault. So again, I think you can play exploration, and I think you can kind of backstop that with some value if you're picky in what you look at. And then for those that want to roll the dice more, obviously you've got some much higher risk exploration out there that I would say is probably, in the whole scheme of things, relatively cheap. But you have to make sure that these companies can raise money, or the share price isn't going to do anything. And that's probably the biggest sticking point with touching the exploration companies at this point.
Well, Brian, I listened to a lot of your interviews with other folks over at Mining Stock Education, and you usually ask people the question that I'm going to ask you, and that is, what about selling? Everybody talks about buying, but when is it the right time to sell? Because you've had big winners like G Mining or Montage Gold, or if Aurion does structure a deal with Rupert and they come out with a big, blast higher, at what point do you sell a winner? And then at what point do you cut a loser?
Great questions. So I've got at least one example. So Montage was a huge winner for us. Its valuation, I forget what the market cap is right now, but when it was almost a 300% win in the portfolio, I cut that position in half. That went from a 10% weighting down to a 5% weighting, and we took profits. And then that money, if you look at how the portfolio is set up, that 5% is actually still sitting in cash and it can be redistributed at any point. With G Mining, I think it's a little bit different with them being in production, especially hitting nameplate capacity in their commercial production probably sometime in February. I haven't been as prone in taking profits from G Mining, especially because they did that deal with Reunion Gold for Oko West. But I think the Montage profit taking was built on the fact that they hit the price target that I had set out, and really until they construct this thing, I don't think the share price is going to move without the gold price going up. And in G Mining's case, I think that there was enough catalysts ahead and enough value to be gained, such as hitting the production numbers and then the milestones they have with Oko, that we could wait a little bit longer and stretch that out. And I've been correct so far. So you have to have a plan of how that share price is going to go up, and you have to have a value that's associated with it. And when it hits those marks, that's when you start taking money out of the investment and start redeploying it into things that are underperforming or brand new deals. But that selling component, that's where I would say that most investors fail, is selling. And for me, it was basically that. Now I wouldn't say last, because I'm always learning, but it was that last major hurdle that I had to personally take. And it was around 2019 where I was so lucky to have a mentor really hammer it into my head about selling. And so I've gotten much better at taking profits and redistributing, especially when price targets have been hit and the market is with you and the volume's there to take those profits.
Brian, let's talk valuations then, because look, again, you dive into these companies, these economic reports, and all we hear from companies is how undervalued they are compared to the NPV in whether it's their PEA, their PFS, or their feasibility study. I know there's not an easy answer in terms of it's 0.2, 0.3 of whatever that NPV is, but when you analyze these, what comes into play in your eyes? What makes the biggest changes in terms of how you value the underlying company, market cap wise, when you compare it to the net present value of their economic studies?
That's a good question. It's such an individual thing, because I wouldn't say it's necessarily one thing. It's how all of those things come together. I'll give you an example, and it's a company that I think is undervalued. I have it in the portfolio. I own it personally. Thesis Gold. They're located in the Toodoggone region of BC. And so for me, I think Thesis is a really good example of being undervalued, especially when you compare it to its overall NPV and the DCF I put together, which is definitely more stringent. Like, I use a 10% discount rate. I'm usually a little bit harsher on the CapEx and the sustaining CapEx, just to give me a little more level of safety. But the things like for Thesis, you've got around 5 million ounces of gold equivalent that's located in central BC. That in itself, I think, is one of those things that give it an extra mark in my perspective, because I do think that a lot of, and to me, this would be like a mid-tier gold producer that would most want to have something like this. And that 5 million ounces is significant. The production profile that goes with it, 200,000 ounces a year projected. These are things that separate it and put it in a class of its own. So 200,000 ounces a year for more than 10 years, like, this gets extra marks, or gives me more confidence that the valuation that they've shown in their PEA, or the valuation I have, will actually be realized. Its location. The big question mark for BC is whether they have First Nations approval or a good relationship. And I think that's to come for Thesis. Not that it's not there, but I think publicly you're going to see something this year that proves it. Next to that, the metallurgy is super simple. I think, again, a lot of people, investors wise, they probably don't even contemplate metallurgy. They'll look at the end result, and that's good enough. But the fact that their metallurgy, especially between the two deposits, this is Lawyers and Ranch, are so combinable. Like, there's seemingly no losses between the mixing of these two ores from the two different deposits. And you're still getting high amounts of recovery, and it's simplistic. This is nothing new. And so again, the metallurgy and the mineral processing, the simplicity of it are, again, a big check mark in my box. And I don't have to discount that anymore to be comfortable with it. So I would say, like, those are the big ones: location, size, simplicity. And of course, I would say open pittable is usually going to be higher on my list in terms of my confidence in what I'm able to model. I'm much more comfortable modeling open pit projects than underground. And yeah, so I would say it's sort of that, and probably in that order, starting with size and then working down to the more technical stuff for the open pit mining and the mineral processing.
Well, Brian, just taking the converse of that and looking for the things that you don't want to see, I guess we could flip some of those answers on their head and say that, hey, the inverse would be a stay away. But we were just at mining conferences. We saw hundreds of companies, not just that were presenting and had booths, but also all the companies cruising through that are also doing mini presentations in the aisle. You probably got bombarded like we did. What are the red flags that you think, or maybe I like the team, but the project's an issue, or, hey, I like the project, but I don't like the team. What are the things that just send you saying, hey, I'm not going to look at that one, or that's off the list?
I think right now location is definitely a big one. There's just some locations around the world, such as Papua New Guinea, for instance, that I just don't have any time for at all. And there's a few more. I think that overly promotional management teams that maybe are a little bit too in people's faces, or my face in particular, again, I just don't have the time to be bothered with listening or trying too hard to learn about it, and maybe to my own detriment. But these are just things that I personally don't necessarily like, and definitely use, and it's definitely saved me a lot of time. And I think the biggest thing right now is that I know the companies in my portfolio so well that when there starts to be points in the story, if a management team is telling me it and I don't quite understand, I'm less likely to want to put too much time into digging in. There really has to be something that catches me off the top in terms of, like going back to what I said about what I value the most in terms of valuing these projects, like size. Size is such a big thing. Like there's so many million ounce deposits or 500,000 ounce deposits out there. And some of these companies have, probably realistic reasons why they're undervalued in comparison to what that's worth. I just don't think it really matters right now, at least in this market that we're in. If you've got 500,000 ounces and maybe with 100 or 150 million, you can put it into production. I don't know that really matters yet. But you have something like Thesis, you have 5 million ounces gold equivalent. You've got this 200,000 ounce per year projected production profile. Yeah, I'll listen. I'll try to learn that, because there's just not many of these out there. And to me, considering I still think it is a stock picker's market, I think those are the ones that are going to stand out, and you have the best chance of getting share price recognition above all the other ones. So I guess it goes part and parcel with how I look at the other companies. It's sort of the same.
Hey, it really is still a stock picker's market. It might remain that way for quite a while, but fact of the matter is there's a lot of different stocks to filter through, and I like how tight you keep your portfolio too, Brian. You really do focus on really a select number of companies and make sure that that story is developing the way that you want to see it. It's not necessarily easy in this sector, especially when you don't see those broad revaluations, but there are a number of good stories out there, so you stick to the ones that can raise money and have money. You can do pretty well, especially in this environment where metals prices seem to continue to trend higher. Again, Brian Leni, founder and editor of the Junior Stock Review. Click that link in the show notes to follow along with Brian. Brian, great chatting with you today. Thanks for your time.
Thanks for having me, guys.